on YouTube? Welcome back to another video with the Houseman Investing channel. In today's video, we're going to go over some stock picks I got for you guys, some stocks I've analyzed here today. Some are new to the watch list, others are stuff I've added back, stuff I've already swing traded, or stuff I'm already holding long term. So we'll jump right into it. As you see here, we have Main Street Capital. This is an investment REIT, so it's going to pay you a nice monthly dividend. This is something I've already gone over in previous videos. It's something I'm already in long term, and I'm swing trading. I already got a swing trade position that's going to start on Monday, and I just added it back to the watch list to continue to swing trade it again. It's been beat down due to the pandemic, so it's got about a 17% upside. Pays a big dividend, a nice great dividend of 7.63. And earnings have been falling, so hopefully they'll get back on track here in 2021. And basically this company is they deal with customizing debt, equity financial solutions, to lower middle market companies. Their support for portfolio deals with like buyouts, recapitalizations, growth financing, refinancing, and acquisitions of companies' annual revenues between 10 and 150 millions. It also offers financing alternatives to entrepreneurs, business owners, and management teams. This is a financial investment service company out of Texas. Next here we got a new stock pick. These are going to be some quite a few ETFs today. I like ETFs. I'm in well over 500 stocks here, so, and I have 400 or 500 on the watch list, so got to mix in some ETFs there, just to give me a hedge and give me some safe plays. So this is a Wisdom Tree fund, ticker QSY, and basically they're using like a model-based selection process. It aims to identify U.S. and large and mid-cap stocks that provide a high total shareholder yield with qualified characters. So this one here's got a pretty decent dividend of 1.63, 25 on the PE, 49 billion market cap, and this is something that's not going to fluctuate very much. Over the past 5 years, it's only up 55%. It was beaten down during the pandemic, of course. It was down about 39-40%. It's pretty much ran all the way back up, so it's starting to consolidate. It's just going to slowly grow while paying you, that monthly dividend. ETFs are super diversified. They usually have, pretty low volatility. So it's just a safe place, somewhere to put your money in and collect some, some dividends, either monthly, quarterly, or annually. Then we got ticker SOE, another Wisdom Tree fund. And this is emerging markets ex-state-owned fund. This is up 26% on the year. It was down about 28% during the pandemic. So it's steady, slow growth. Doesn't fluctuate very much as well. Does pay a little bit of a dividend of 1.02%, $3 billion market cap. And basically, it has a weighted index of emerging market companies excluded from state-owned enterprises. And Wisdom Tree has pretty good funds, so you're going to get some nice picks, and it's going to be a basket full of those. Then we got another Wisdom Tree fund here, which is WCLD, and this is going to be cloud computing fund. So cloud computing companies, cloud software and services. This is going to be a fund with the best of those type of companies in it. It's not a dividend payer. It's more of a growth play. It was down about 22% during the pandemic, but it is still up 107% on the year. And it's a fairly new IPO here. Started back in September of 2019. So it's going to be a nice growth, diversified, low-risk play from Wisdom Tree. Then we got another Wisdom Tree ETF. This one's going to be in the Japanese market, so this is going to give you exposure to other markets outside the outside of the U.S. And it's always good to invest in other markets like China, Japan, Europe, Africa, Canada, You know, something outside of the U.S. Sometimes it's hard to pick stocks, you know, from outside of the United States. I mean, you have your given companies like Alibaba, Jamia, Neo, and things of that nature. But the funds and the ETFs are just a good way to get that exposure with plenty of diversification and low volatility. This one here has been beaten down. It was down like 24 or 30% during the pandemic. It's on its way back up. It's actually still up 2% on the year. Pays a decent dividend of 2.53%. And like I said, this is going to be a dividend weighted index of Japanese stocks. So basically, the best Japanese companies with the best dividends, that's just going to be ETF full of those companies. Then we have ticker HEDJ. This here is a Wisdom Tree ETF, and this is based out of Europe. This one was also beaten down during the pandemic, about 30%. It still has probably about 6% growth left in it, 6 or 7%. Decent dividend of 2.65%. And it's going to be an index of Eurozone dividend-paying companies that derive a majority of revenue from exports outside the Europe region. So basically, the best European dividend companies are going to be all, you know, in one ETF from Wisdom Tree. Then we got EPI. This here is a Indian earnings fund, so more exposure to another market. Beaten down during the pandemic, about 30-40%, still up 17% on the year. So this is a good growth play. 15.93, nice PE. Small dividend yield of 0.78, so you'll still get a small little payout. And this is basically a total market index of Indian companies selected and weighted by earnings. So the best earning revenue companies out of India are all going to be in this fund here from Wisdom Tree. Then we have another Wisdom Tree fund, CXSE. This is a China exchange owned fund, so this will give you exposure to China. It was down about 16% during the pandemic, still up 55% on the past year. So this is a nice safe growth play as well. Small dividend of 0.54. Like I said, it's going to be a nice little growth. It's going to track Chinese weighted companies that are not state owned, so defined as government ownership of less than 20%. So some nice exposure there to the non-owned government companies out of China. Then we have ticker DOM. This here is a Wisdom Tree US mid-cap dividend fund. So the best dividend paying mid-cap valued mid-cap market cap companies are going to be, you know, all in this fund. It was beaten down about 45, 50, almost 50% on the year. Still has a nice about 7-8% growth left to go here. Nice dividend yield of 2.77%. And like I said, it's going to be the best dividend paying mid-cap companies from the U.S. provided by Lending Tree. Then we got DGRW. This is a U.S. quality dividend growth ETF. During the pandemic, it was down about 25%. Still up 11.5% on the year. Pays 1.90% dividend. So this is going to be something that's going to be something that's going to grow over time. Plus, it's going to have the best dividend payers. So this is the best dividend growth paying companies, large and mid cap, from the U.S. market. You know, provided here by Lending Tree. So another nice, safe money play here. And you got ticker DES. Pretty much the same thing as a mid cap, but it's related to small cap. So the best small cap dividend companies are going to be in this fund here. It's down about 43% over the pandemic. Still about a 6% growth left in this company here. Pretty nice dividend of 2.75. So best small cap dividend companies all in one fund provided by Lending Tree. Next here we got BZUN. It's also a nice little play. It's not a fund or ETF. It was beaten down just a little bit, you know, through the pandemic, about 30% or so. Over the past 5 years, it is up 288%. so it's still making a comeback. From that pandemic. This is more of a growth play than a dividend play. 15 analysts, 80% buy rating. Very nice EPS. This is a software company out of China. Through its subsidiaries, it provides brand electronic commerce, e-commerce services, and solutions. Its services include apparel and accessories, appliances, electronics, home and furnishing, food and health products, beauty and cosmetic, fast-moving consumer goods, mother and baby products, and insurance and automobiles. So this company related to e-commerce has their hand pretty much dipped in everything. Sort of like Alibaba or Amazon, but it is a nice growth play. So of course they're gonna, most likely be profitable next year, with people being able to get back to work and things of that nature and be able to spend a little bit of money. I do have JMI, I do have Amazon, companies like that, BABA, Alibaba, but I always look for plays that I'm not into, some stuff that I've never heard. I try to research and find those companies and look at the balance sheets and look at their fundamentals, do a little background check and research on their board members, as well as on some of the analysts with the bullish thesis. I'll look at their track record and their basically their percentage of plays that they make. I'll look at their percentage of gain to loss, comparison. So this is a new play for me. So I'm gonna go ahead and swing trade it and see how it works out. Next we got SJNK. This is a Bloomberg bond ETF. I like Spider, I like Bloomberg, and I like Barclays. And I also like bonds. Bonds are something that don't fluctuate much at all. This bond was down 12%, almost 20% during the pandemic, but it's already recovered. Over the past 5 years, it's only up 4%. Before the pandemic, it basically stayed within a few percentage of itself. So this is something with very low fluctuation, very low volatility, but it's going to give you a nice dividend payout of 5.34%. So this is just a short-term bond publicly issued by U.S. high-yield corporate bonds with the remaining, it's basically less than 5-year bond, So it's going to be a nice, safe place, somewhere to put your money, a hedge against the market. It's a lot better than a bank because you're going to get some nice dividend payouts for it. Very nice interest. Next here we got ticker UCO. This is a Power Shares crude oil. This is something I'm already swing trading this month. A very nice play. If most people know about stocks, know that oil has done very poorly. So this thing is down, pretty much about 90, almost 100%. The 52-week high for this fund is $553, and it's sitting at $36.15. So a lot of growth still left. A lot of people sleep on oil. I mean, if you look at trucks, jets, planes, and things of that nature, I mean, they all run on fuel. We still use oil every day. Me being a truck driver, I can tell we use a lot of fuel, so that's a lot of oil being consumed. EVs are the new wave. They will eventually probably take over along with the robots, but that's not going to happen for at least 3 or 4 decades. So oil is still something I get into for a bounce back play. And this here is a 2 times the daily return fund. So basically with crude oil, the movement of it, it's going to be 2 times effective. So either it's going to do twice as good or twice as bad. And with it being beaten down right now, I see a bounce back in 21 for for the oil sector of the market, with everything opening up and stuff like that. Next we have ticker FLRN. This here is a Spider fund from Bloomberg Barclays. This is a grade floating rate ETF. This is something that doesn't fluctuate at all. It stays within maybe 1 to 2% of itself. During the pandemic, it was down like 10%. It's already recovered. So this is very, very low volatility with a small dividend payout of 122. So a nice place to keep your money at, make a couple dollars off your interest. And this is a grade floating rate notes. Securities have between like 1 to 5 years of maturity. So a nice safe play, again, to store some money at. You know, if I'm putting $28,000 into the market, I do want to store some of my money in some safe plays, because I do have some very volatile plays, some nice growth plays, some bounce back plays, value plays, dividend plays. I kind of just spread it out and diversify as much as I can. That way I minimize my risk and pretty much guaranteed myself to make some money. I've been doing this for the last 6 months, this strategy here, and I've made a little bit over $12,000. So, you know, obviously it's working. Not only have I made $12,000, but I've accumulated nearly 1,000 shares of basically free house money stocks. Because what I do is put my principal into the market, pull out my principal, leave all my gains in the market. Next here we have a SPDR fund, ticker BWX. This is a Bloomberg Barclays International Treasury Bond ETF. This thing also was down during the pandemic about 8%, 10%. It's already recovered. It's still 8% up on the year. Small dividend of 0.95. So this is going to have a little bit more growth to it. Not too much. You know, you can probably see anywhere from, I would say, about 4% a year on growth. So you'll get a 4% growth rate along with about a 1% return on your money. So it's basically like 5% interest if you look at it like that. And what they do is track, you know, market value weighted index, investment grade fixed rate government bonds issued by countries outside the U.S. So nice security bonds, and it's nice to get some, you know, that are outside the United States. So the best ones are going to be right there in that fund. Next we have SHM. This here is another SPDR Barclays fund, and this is another bond, a short-term bond. This thing isn't going to move, you know, up or down more than 1 or 2%. Of course, during the pandemic it was down about 5%. It's already recovered. Pays a decent little dividend of 1.16%. And these bonds are rated like AA or better. So these are some of the top of the line bonds from Bloomberg Barclays. And like I said, you're going to make a nice little return of 1% or 2% on your money. You're not really going to make any growth, but you're also not going to lose any money as well. Next we have ticker TFI. This is another SPDR municipal bond ETF. This one here is going to stay in a nice percentage range. You might gain 1% or a little bit less in a year. It was down during the pandemic, of course, about 7%. It's already recovered. It's actually up 3% on the year. And like I said, you're going to see maybe 1% or 2% of growth with a nice little dividend of 1.91. So you'll make anywhere from, you know, 2 to 3 to 4% interest on a safe play. And these are long-term tax-exempt U.S. bonds. And once again, Bloomberg is a nice, very nice ETF, a very nice hedge fund company. Then we have ticker HYMB. This is another Barclays high-yield bond. So super low volatility. It might fluctuate anywhere from, you know, 4 or 5%. The growth will probably be around, you know, probably less than 1% of growth, but you are going to get a nice dividend payout of 3.55%. So 3 to 4%, you know, with the growth about 5%. I say safely about 4% interest on your money, you know. And this is basically a fund, a bond fund, and it tracks out of the index the bonds with the highest yield and investment grade, you know. So very high rated companies with the great dividend yields. So a nice money play there. Get you some nice income, passive income rolling in, as well as, you know, kind of save some money on the side. Then we got ticker XLE. This is something I'm already swing trading as well. I'm going to swing trade it again. This is an energy sector SPDR ETF. SPDR is great ETFs. The energy sector is really hot. It was being down about 60% during the pandemic. This one still has a lot of growth left in it. This is a play I really like. And now I'm swing trading again because it's still going to grow about another 23%, right? And it's got a nice dividend of 5.62% and a super low PE ratio. So this thing is super undervalued at the moment. So you're going to collect that nice dividend of 5-6%, plus you're going to get that nice growth of about 23%. So this is a big money play here. Nice returns going to come out this one. And this tracks the best energy companies out of the S&P 500. S&P 500 is the top 500 companies in the world. So the top energy companies, they're going to be located in this ETF. And Spider's a great fund manager. Then you got ticker XLF. This is a financial sector Spider fund. This here was beaten down about 35% during the pandemic. Probably has about 3 to 4% growth left in it. Nice dividend yield of 2.03%. And this tracks the best financial stocks out of the S&P 500. And this is also a Spider fund. So as you can see, I kind of like diversify myself in every sector of the market. You know, of course, some are going to lose, but most of them are going to win. And with these bonds and treasuries and ETFs and funds, the volatility is very low anyway. I mean, the pandemic's like once in a century thing that happens type thing. You know what I mean? If that often. So that's the only time I lost money. But as you can see, they've all recovered. So I just like to be super diversified, have my hand in a little bit of everything. And some are going to lose a little bit, some are going to gain a lot. Even on the individual stocks, some might do very bad, but there's going to be a lot more that's going to do very good. Next we have ticker XLV. This is another Spider fund, and once again, more diversification. This one's in the healthcare sector of the market. It was down almost 30% during the pandemic, and it's already ran up. It's up 12% on the year. So this one's going to give you healthcare, which healthcare nowadays is more important than ever, as we've seen. If it wasn't, it kind of taught you a lesson about keeping up with your personal health. So it's a nice little growth dividend payer, a small dividend of 1.49%, and this is going to track the best healthcare stocks out of the S&P 500. So out of the best 500 companies in the world, we're going to take out the best healthcare stocks that are there, and we're going to put them in one fund provided by Spider. So another nice growth dividend payer. Next we have another fund by Spider. Once again, another sector. This is in the industrial markets. It was down 34% during the pandemic, still up 8% on the year. Nice little dividend of 1.55%. And once again, out of the S&P 500, the best industrial companies are going to be tracked. They're going to be listed here in this fund. And you better believe these industrial companies are going to make a nice pull up here in 2021 when everything opening up. There's going to be a lot of renovations, a lot of more building, all kinds of stuff going on. So I see them making a nice little, growth gain next year while collecting that dividend at the same time. Then we got ticker XLU, another Spider fund. And this is another sector, guys. This is a utility market, right? It was down about 30% during the pandemic. Still has about a 2% growth left in it, while paying a pretty solid dividend of 3.14%. My sweet spot for dividends are 2 to 4%. I've learned over time that's not, it's enough money, it's enough dividend that I'm making a good cash flow, and it's not too much that the company is just paying out too much of their profits. Because if you shoot for these companies with these high dividends of 15 and up, then those companies are pretty much going to zero out, and you'll lose more than you got paid in dividends. If you get something that's super small in dividend payouts, you're barely going to get any passive income. So that company better have some growth to it. So that 2 to 4 range I found is a sweet spot of nice solid growth along with a nice solid payday. So this here is going to track the top utility companies out of the S&P 500. So once again, exposure to different sectors. Next we have IDNA, and this here is a Geonomics healthcare fund by iShares. Geonomics is something that Cathie Wood just recently came out and said is going to be one of the new waves, and everything she takes, you should take it with a lot more than a grain of salt. This here is pretty much a growth fund in this sector, and it's been booming like crazy. That's why it's up 56% on the year after being down about 20%, in March in the height of the pandemic. It also pays a very small dividend of 2.6, so you get a nice little payout. And this is going to attract the best genomics, immunology, and healthcare ETF companies out of the global market. So basically, all the companies in the world that are involved in healthcare and genomics, the top companies in iShare opinions, they're going to be here. So you're going to see nice growth, and you're going to get a small little pay for holding that stock. EWZ, this is something I've just recently swing traded here, and this is a Brazil fund. It's a fund from iShares, and this thing here was, beaten down about 50-60% during the pandemic, of course, and it's still got a little growth left in it. I'll say about 22-23%, and it does pay a dividend yield of 1.71, so you're gonna get nice bounce back growth along with that dividend. And this fund here by iShares is gonna attract the best Brazilian companies. So once again, exposure to another market outside the U.S. is always a good idea. Then we have Global X funds. This is an X Cloud computing fund. This sector is, it's also booming at the moment. This thing was down, about 20% during the pandemic. Finished the year off up 77%. Tiny little dividend of 0.180. This company, almost $2 billion market cap, super low PE, and this thing is super undervalued. I don't know how it's still trading at $28, with all this growth, as well as the fundamentals, of this fund. And this is a global fund as well, and it's going to attract the top companies in the cloud computing industry. This industry just kind of took Wall Street by storm, and nobody was expecting the the advances that they made. So that's why it's still trading at a super valuable price. So this is a nice play. It's going to be a nice growth with a small little payout as well. Next, we got ticker BOTZ. This here is a robotics and artificial intelligence ETF. This is something I already own. Artificial intelligence and robotics, I mean, it's the new wave. These things are taking over everything, from your self-checkout lines at Walmart to delivering your pizzas to driving your cars or anything else you can think of. This is going to be something that will continue to grow, over time. So to be able to be in this type of fund is a great resource for me. That's why I'm swing trading again, even though I own it. So I'm trying to build my position in it more than what I have. I'm currently up 16.81%. Now, it was down about 30% during the pandemic. Still finished the year up 50%. And I'm up 16%, right? Decent PE ratio. Does pay a very small dividend of 0.19. But hey, any dividend is better than no dividend. I got in this back in October on the 6th. And this is going to attract the best robots or artificial intelligence companies, with the nice market caps. So this one's by like $3 billion market cap. So a lot of growth here, a lot of innovation still to come. So definitely, an ETF I want to be in. Bots. Next we have LIT, L-I-T. LIT. This is an ETF dealing with battery, lithium and battery technology, right? Everybody knows lithium and lithium batteries and the technology involved is super booming, right? You got all these EVs coming out, they got to run on batteries. So this is an ETF to give you some of the technological advances they're going to be here. This company here was down about 30% during the pandemic. This is a nice little growth play. Finished the year up 127%. Nice gains. Just like the other ones, it's going to pay a small dividend of 0.40%. And this company has dealings with Tesla and other electric vehicles, right? And this ETF is going to track the best lithium miners and battery producers. So you got to mine lithium to build the batteries, and then you got to build the batteries. So this ETF is going to have those two sectors. The best of them are going to be provided by Global X. And this is, you know, these type of companies are all from around the world. They're the best ones that exist are going to be here, and that's why it's had so much growth. Then we got ticker MLPA, another Global X ETF. This thing here was, you know, trash during the pandemic, right? It still needs to recover. It's still beaten down. It still has the potential of running up another 42-43%. This is one with the super high dividend, but there's potential for the growth, even though they pay a lot out on dividend, because they also, you know, make a lot of money. The dividend on this company is 16.16%. So a great dividend. And this is going to track U.S. listed midstream MLPs and its structures as a C corporate. So I see this thing bouncing back, you know. I would say at least 20%, you know. But I think it can recover the whole 40 plus percent, just because, you know, the pandemic's going to be over soon. So of course they're beating down, paying that high of a dividend and not pulling in, you know, the revenues that this sector should pull in. So it's super undervalued, super oversold right now. So definitely something I'm going to sweet trade and, you know, take a risk and see what happens with it. Next we got ticker FINX. This is another Global X ETF, and this is in the fintech sector of the market. Fintech is very popular right now. This one's done very well. It was down about almost 40% during the pandemic. Still finished the year above 51%. So this has got nice growth. Very small dividend of 0.29. And this is going to track the best fintech companies, you know, in the world. The best financial technology producers and the ones that provide the best technology service. They're all going to be in this ETF worldwide, and you're going to get a nice little pay for holding it and some steady growth. Then of course we got FANG stocks, right? Ticker FNGS. This is in the micro sectors sector of the market. This thing here was down about 20% during the pandemic, still finished 96% upward over the year. So this here is just tracking some of the best micro sector companies in the, you know, the best micro sector technology and consumer discretionary companies, and it's selected by you know, a certain committee. So this micro sectors fund is going to be super growth stock, right? And you could expect this thing just recently IPO'd back in, I think, late 2019. So, you know, first year out, it's up 124%. If you can make those gains every year, hey, that's a solid play. Then we got ticker FNGO. This here is another micro sector. It's basically the same as the last one, but this was the 2X. So as that one was up 123 on the year, this one was up 225% on the year. Also IPO'd just a little bit earlier. So this one has a potential of 200 to 300% growth per year, and it's going to track the best you know, technology and consumer companies in the fintech market. No, I'm sorry, not fintech. I meant a semiconductor market, right? So yeah, big growth potential here. A little risky, but hey, it is an ETF. So even though it is risky with the double leverage, it's still not too bad, because it's, you know, it's a bundle of those companies all in one. So definitely want to jump in there, see if I can't grab some of that 200-300% potential it has. Then another stock I'm excited about, This is something I've recently traded. This is Luminar Technologies, ticker LAZR, and they just recently IPO'd. They're up 204% on the year, doing very well. This company here does like they do things related to, you know, autonomous driving with the sensors and things of that nature. Like Tesla uses like cameras and all that type of stuff, but most car companies are big on like the sensors. So this gives you exposure to that. It's going to be nice growth here with this company, as all these EVs and self-driving cars are coming out. They have a a deal. They have a deal on the table with Xpeng or XPEV, a Chinese EV stock, probably the third best EV stock in the market. So, you know, we'll see what happens. And like I said, they do, they have technology to do with the self-driving vehicles and autonomous driving, and did well his first year out. And I think this market, well, of course everybody should think this market is expanding. So, as long as their technology and their products are good, then they're going to continue making money. So definitely something I'm going to swing trade. Then we got ticker Robo, ROBO. This is a ETF in the robotics and animation sector. This here was beaten down about 30% during the pandemic. Still finished the end of the year out up 44%. So a nice growth play. Does pay a small dividend of 0.2%. And this is basically going to track the best companies involved in robotics and animation. And this is a Robo Global fund, so it's going to be worldwide. And they use kind of like their own little weighted strategy that they use for their funds and their ETFs. So obviously it's working well for them. Robotics and animation is a big sector to get into, a growing sector. So of course I'm going to try that one out. Then we have IRBO. This is the iShares Robotic and Artificial Intelligent Multi-Sector ETF. This is something I already own. I'm currently personally up 14.42% on this one. During the pandemic it was down like 20-something%. It's up 40-something% on the year. This is going to be a growth play. Nice little half a dividend, 0.53% dividend payout. And this is going to be iShares best robotic and artificial intelligent companies. As you can see, I already own something in this sector, but I'm steadily looking for more funds and shares, ETFs and funds and stuff of that nature from other companies like Bloomberg or ProShares or Spider or First Trust, companies with good track records, like these funds with good track records. I'm always looking to get into these same sectors with those companies as well, because I know they will perform right on line with the ones I already have. Like the one I have with iShares and the one with the Robo Global is pretty much going to run side by side. So definitely something to look into, guys, with the robotic and intelligent sectors. And this one is from Dexron, and this is in the same sector with artificial intelligence and automation, but this here is a 2x leverage bull ETF. So this was going to double up. It was being down about 70, almost 80% during the pandemic. Still finished the year up 50%. This one here is one of my favorite plays that I have on the list because of the growth potential and the dividend. So the dividend is 6.92%. So you're going to gain about 7% of interest on your investment, as well as growing. It is super volatile because it's a times 2 leverage, but in my opinion, this sector of the market is going to boom. It's been rising. It's going to keep rising. This isn't going anywhere, and this ETF is going to give you plenty of diversification over that market. And I love this fund here, so definitely something I'm going to build a position in. Then we got ticker ROBT. This is First Trust, same sector, artificial intelligence. This thing was beaten down about 30% over the pandemic, still up 45% on the year. So you're going to get great growth. I would say probably about 65% growth out of this company per year on the high side, with a small little dividend of 0.170. And what they do is track roughly about 90 all-cap global companies involved in artificial intelligence and robotics, listed from the NASDAQ. So just more exposure to that sector and more exposure to different ETF and funds. That's what it's kind of what it's all about in this video. Then we got a FTSM. This is a First Trust Enhanced Short Maturity ETF. This thing will not move over 1%, either up or down, pretty much guaranteed, unless we have a pandemic again, because it was down about 3%, but it recovered immediately. It didn't take full recovery, happened about 3 months later. It didn't take any time for this thing to run back up. It's going to pay you a little solid dividend of 1.2%, so a nice little return on your money. And this is a fixed income security from First Trust. So nice, like I said, just another nice little place, somewhere to set your money at, gain some interest on it, and pretty much be guaranteed your money's going to stay there. Don't expect any growth. Then we got ticker FVD. This is another First Trust fund, and this is a value line dividend ETF. And this thing was beaten down about 30% during the pandemic. Still has about a 1 to 2% upside, along with a 2.31% dividend yield. So you can possibly make, anywhere from 2 to 5 to 6% here on this play. And this is a weighted index that tracks the best dividend-paying companies out of the market. It excludes companies with less than $1 billion in market cap. So risky, ranky, and lower than average dividend yield companies, they're not going to be there in this fund. So this is the funds with a bigger market cap, more established companies that pay these great dividends. They're all going to be in this one ETF. So of course, you're going to see that growth potential. I say about 9% a year. It's going to probably compete with, right around the SP 500, and it's going to pay a nice little dividend of 2 to 3%. So definitely another play that I like. Then we got ticker FIXD, another First Trust funds, and this is a fixed income ETF. This one here was beaten down during the pandemic, about 5%, immediately recovered, finished the end of the year at 5%. This one probably grow anywhere from 4, 5, 10% per year as well, with that nice little dividend of 1.99%. So 1 to 2% interest, as well as with a nice little growth. And this is a bond fund, like I said. Then we have another First Trust fund. This is Industrial Realty, ticker FR. And this is going to be a monthly payer, right? So dividends every month. Beaten down about 30% during the pandemic. Still grew. Finished almost 3% upside. This is going to pay you a nice 2.37% dividend every month. 2 to 3% return on your money. And this one probably grows actually pretty well, around, probably about 10% on the year. If you look at their EPS, they were just murdering, their EPS. Great analyst ratings. 10 analysts got it 50% buy, 30% hold. And this is a real estate investment trust. It engages in ownership, management, acquisition, sale, development, redevelopment of industrial real estate. They have like warehouses, light industrial properties, and things of that nature. So definitely something that's going to make money. It's going to give you nice growth, nice exposure, along with a nice monthly payment. So definitely another fund that I really like a lot. Ticker SKYY. This is a cloud computing ETF from First Trust. I'm already into these cloud computing funds, so I found one here with First Trust that I really like. It's very growth oriented. It was down almost 20% during the pandemic. Still finished almost up 60%. Very small dividend of 0.17, But like I said, it's an ETF, so it's going to be face more toward growth when dealing with cloud computing. This is a growing sector of the market. With the platforms, the software, the infrastructures, and things of that nature. So great diversification, great growth with a small little payout, as a good incentive. Then we got ticker FTCS. This is a First Trust Capital Strength ETF. This one here was beaten down about 20-30% on the year. Still finished above 10% growth. So this one thing is going to give you nice solid growth as well, with a small little paid dividend of almost 1%, 0.93%. And this basically targets companies with strong cash balances, low term debt, and high return on equity. So a very good ETF. So get great cash, low debt, great return on equity. Can't beat that. All bundled into one ETF. So you're going to get that steady growth with a small little 1% gain. Can't beat it. Then we got ticker HYLS. This is a first technical high yield ETF from First Trust. This thing was, down 20% during the pandemic. It's already recovered. It basically came back. This thing isn't really much of a growth play. It usually doesn't gain even a 1% per year. It doesn't fluctuate up or down very much. The pandemic, prior to the pandemic, you've never seen anything like this. You never seen a drop like that. But of course, it bounced right back up. So this is the ETF focused on high yielding dividends. Nice payout of 5.09%. So a very, very nice return. And it holds up to like 130% in long positions in high yield bonds. It expects to perform up to 30% on short positions. So these high yields are expected to perform anywhere from 30 to 130%, which is awesome. So a nice safe play, like I said, with a nice payout about 5%. Then we got ticker HTEC. This is a global healthcare technology and innovation fund here. This is based on growth. It's down about 20-30% during the pandemic. Still finished a year up over 60%. This thing has massive upside. Healthcare technology is booming. I mean, they're just coming out with like handheld scanners where you can diagnose your illness, or if your wife's pregnant, you can do the scan on the stomach and see the baby. I forgot the term or whatever, but yeah. See if I can think of it. Yeah, I can't think of it. I don't have kids, so I really don't know. But yeah, this sector is booming. This had a nice growth last year. It has a lot more potential growth. There's a lot of companies involved in this industry, so this will give you, just a fun with the best of these companies all in one that are growing substantially. Nice little, small dividend, 0.29. But like I said, the best healthcare technology companies around the globe, they're all going to be in this one ETF. So massive growth potential, great diversification. Then we got ticker THNQ. This here is a global artificial intelligence ETF. This thing here IPO'd after the pandemic, so it finished the year off up 60%. Like I said, artificial intelligence, booming market. This one does have a very small dividend of 0.31%. So nice little return, but you're into a market that's booming, so you're going to see nice growth. I mean, if you can get 60-50% growth, hey, you can't beat that. Then we got ticker GUSH. This is something I've already swing traded. This is a bull ETF. I actually got a pending order that's going to be purchased on when the market opens. And this is like the other Dextron gas and oil and production ETF, but this is a bull ETF. This one is a 2 times share bull. So very risky, very volatile. Oil has been killed, like it's been beaten down. Like people they've lost money on this play hand over fist. If they held throughout, the course of time, this used to be like 20, almost $25,000 per share, right? Now it's at $38. So somebody has lost massive gains in this company. You know, big percentages of money have been lost. But like I said, oil ain't going nowhere. This thing is, you know, hit the floor. So I'm going to jump in, see if I can't catch some of that momentum back up, catch a nice little bounce back play, and receive a little small dividend of 0.26%. And it's going to track the largest oil and gas exploration and production companies in the U.S. So a great play. Great potential play. Then we got CSSR, something I'm swing trading heavy this month. Calciera Gaming. This is a new recent IPO from September. Hey, it's up 115% still. You know, this thing's running up. Great earnings. This is a hardware electric components company out of California. And basically what they do is design and supply hardware components for personal computers. Hey, nice big sector. People are quarantined. They got to be on their computer, right? Playing games or whatever it is. Then you got ticker ACWI. So yeah, CRSR is just something I added back. It's something I like. I like the fundamentals, and I'm going to swing trade it again. This is the iShares ETF. This one here also has a nice little growth potential, down 30% during the pandemic, finished the year up 14%, and it still has a nice little dividend of 1.43%. So 1 to 2% return on your money. And this thing does about a solid, you know, 10, 11, I say about a solid about 12% a year in gains from this ETF. And it tracks market cap weighted index of large and mid cap global stocks covering 85% of the developed emerging markets capitalization. So a nice little unique fund here to get some exposure with some great growth potential. Then we got ticker ACWX. Another pretty much the same thing as the last one from iShares. This is more focused on growth. Down 30% during the pandemic, finished the year up 8%, dividend yield of 1.88%. And this one captures 85% of publicly available market, thus including small cap companies. So mid and large cap companies, 85% of them, they're going to be in this fund here from our ETF from iShares. Then we got ticker LGLV. This is a spider ETF, large cap companies, low volatility index. So the companies with the big large caps, the big large cap companies with low volatility, the best ones in this ETF. This thing here was down 25% during the pandemic, still finished up 5% on the year. So this one typically grows about 5, 6, 7, I'd say about 12% on the high side per year, anywhere from 6 to 12 or 9 to 12% of growth. Plus it pays a nice decent dividend of 1.98%. So 2% return on your money with a 10%, 12% growth over the year. Can't beat that. And this is going to be the least volatile Russell 1000 index securities. So super low volatility, nice little growth, nice payout. That was the last stock. It was probably about 51 stocks out of the mostly ETFs or whatever. But yeah, these are ones that I just added to my watch list. We can go see how many I have total on my watch list so I can give you guys an exact number. While I'm doing that, if you like this video, hit the like button for me. I'd really appreciate it. Subscribe, hit the bell, all that good stuff. Let's see what I'm up on the year here in Robinhood, up 35%, $1,300. As you can see, these are all the positions I'm already in. This is over 500 companies, and most of these are just free house money shares. Well, all of these are actually, every single one of them, except for these ones that are zeroed. These are plays I'm making when the market opens. I got probably about a total of 60 plays that I'm making, I had to swing trade this month. And then, of course, I got my crypto. But what we're going to, right here, boom, 515 stocks on my watch list. I'll be getting into every single one of these. So, like I said, I'm over diversified. I'm steady looking for new stuff. So, subscribe, subscribe to the channel. Hit the bell. I'll show you guys. Look, I have 12 brokerages that I display on this channel. You know, I got a total, what, 13, 14, 15, 16, 17, 18. I got a total of 18 brokerages that I'm into. But I do show 12 of them on this channel. You know, all my buys, all my sales, all my deposits, all my withdrawals, you know, my losses, my gains, everything is shown. It's 100% transparency on this channel. I'm going to get straight to the point. I'm not going to beg you guys to like my video 18 times during the video and subscribe, you know, 20,000, 30 times during one video, and, you know, link it to Patreon to see my portfolio and all that extra stuff that you're going to see everybody else do. I'm not going to talk about the same exact stocks as everybody else. I will mention those stocks and I will buy those stocks because they're going to most likely be great stocks. But I'm also going to find the unique place for you guys as well, you know. So if you like that type of content, hit the sub button, hit the bell, get the notification. You know, let's grow this channel. Once I do get this channel, you know, to a place where I'm making money, then what I'm going to do is give back to my subscribers, you know, to my day ones, and I'll be doing giveaways. You know, if I make money on a video, I will give half of that money away, because if it wasn't for my subs, I wouldn't get none of the money. So I'll get, you know, paid half, and I'll give half of it away to subscribers, you know, every video, every month, week, day, or whatever, you know, the case may be. I don't mind doing stuff like that. So if I can grow the channel to that point, I don't mind, you know, giving away a portion of my revenue out to subscribers that are really here for the content. But anyway, just a little rant there at the end. I'll see you guys in the next one. Thank you.